ticker symbol 4 is up over 50% in the past year. And today we'll be looking at a company that is gaining market share in a highly competitive sector, which has clear opportunity for improvement in their margins. They have grown their revenues by 31% in the past year, and their net income by over 60%. So today we'll be looking at none other than Shift4 Payments, a payment processing company. In their annual report, they state that they are the leading independent provider of software and payment processing solutions in the US, which is based on the total volume of payments processed. They basically offer an integration into e-commerce, other websites, or even physical stores to enable a global end-to-end payment offering. This basically allows companies to charge clients for their products, and they allow any type of payment processor, whether it's Visa, MasterCard, or any other type of payment means. Now, the way that this solution offers a lot of value to customers is that there is a very high complexity to e-commerce and other businesses of conducting commerce when it's conducted across multiple channels, geographies, and even systems, which generally leads to sourcing from different providers. For example, a normal company would say, okay, so for the online process, I would use this software in Spain, this software in the United States, and then for physical point of sales, I will use this other provider and this other one. So you end up having a very large supplier base. What ticker symbol 4 offers here is for you to only need to hire one only provider and them to handle everything related to payment processing for your business, whether it's in different geographies, different channels, or anything that you can think of, allowing businesses to take care of what really matters and what they really know, which is selling their products. They offer a seamless commerce experience. It's very easy to integrate and companies don't even know that it's operating in the background. It offers enterprise security, analytics to track their performance, and even compatibility with other POS solutions. They divide their offerings into 3 different sectors. I've only included 2 because I believe they're the most relevant. The first one is the payment platform, where they focus on accepting and processing all the cards for the payment for their clients. And the second one, which is their technology solutions, where they can provide operational data and other analytics for companies to better manage their business. And of course, these are sold as different packages. And when we look at this company's financials, they currently do not look as good, with a mere 1.3% return on capital employed, which has been caused by them not managing to actually increase their margins by a lot in the past years. They have a 3 times interest coverage ratio, which is also caused by their low margins, but this means that if they don't improve their margins in the short term, they should be worrying about this metric. Then they have a solid cash conversion of 75%, a profit margin of 28%, and a slim but improving net margin of 8%. And we can see this over here, where their revenue has been growing extremely consistent and in a very predictable manner, but their net margins have not followed that trend. They have been increasing since December 2023, but they were higher in earlier 2023. We do have to remember that payment processing is actually a business where you handle a lot of volume, meaning that your revenues will be extremely high, but the processing fee you take, or you can think of it as the net margins, they're usually very slim in order to remain competitive and attract clients at the start. What usually happens is that when these companies start growing at a way faster pace and they already have a very established user base, they will then start increasing their margins in order to capture more value. Likewise, we can see how their efficiency ratios have been faring in the past, with the return on invested capital being fairly stable but falling into negative territory in the past quarter. And we can look at their balance sheet evolution, which shows how their total assets have been increasing over the past 4 years, and their total liabilities have been increasing as well. However, they have been maintaining a pretty solid current ratio, which has increased in 2023, which means that they currently hold a lot more assets than liabilities. And when we look at their fundamental analysis, I believe this company gets a solid 5 out of 8. First of all, they have a very solid balance sheet, meaning that they can actually pay all of their current or short-term liabilities with their current or short-term assets. They're also able to generate free cash flows in a very consistent manner, and these have been increasing and growing organically thanks to their organic revenue growth. However, the free cash flow has been growing at a way shorter pace, especially due to those slim margins. However, I believe that this company does have an existing moat, and it's even building a wider competitive advantage over time. There are many competitors in this space, and most of them are offering a very similar solution to the one that Shift4 Payments is offering. However, this company has managed to increase its market share over time, slowly but surely. They have a very high retention rate for their existing customers, and this is because whenever you set up all your processes with a specific payment processing company, it's very rare for you to actually go over the whole process to change everything up. This is mainly due to the fact that if something is working, why change? Unless you've had a very bad experience or you found something extremely cheaper, I believe it's a lot more expensive for you to change provider than to just stay with the one that you currently have. And the thing is that since Shift4 Payments has been increasing all of their offerings and improving the services that they're giving to clients, this has not only allowed their clients to stay with them, but it's also made them take on a wider part of the services that are being offered and overall increase their average revenue per user. Additionally, I believe that this company is in a very similar position as Visa or MasterCard, where each time they have more and more clients, they're able to improve their solution, improve their margins, and overall enjoy all of their network effect that they will be experiencing. However, I do believe that this company does not have pricing power. And the main reason is that this is a sector that has very slim margins historically. Companies such as Stripe or Shift4 Payments are not allowed to charge very high processing fees because this would defeat the whole purpose and companies would just choose other more expensive providers such as PayPal. So these companies are differentiating by offering a cheaper solution or a cheaper alternative. Since I describe pricing power as being able to increase your prices above inflation at a constant rate without losing too many clients, I believe that this company does not currently have pricing power, and it's very rare for a company in its sector to actually enjoy this. On the other hand, this company has high liability risk shown by their 3x interest coverage ratio, and they currently do not pay any dividends, and if you look at their shares outstanding, these have actually been increasing over the past. Additionally, despite all of this that we have spoken about, when we look at their price to earnings ratio, they're currently trading at 60 times their earnings, which is way higher than they've been trading for the past 1 or 2 years. On the other hand, they currently have a 2.90 free cash flow yield, which is sort of aligned with the 3% long-term inflation rate, and this may suggest that the company is fairly valued at the current moment. However, in the graph above, we can see that their EPS has actually been fairly stagnant for the past year as well. Which raises the question, how can a company be trading at a 60 times earnings with very stagnant earnings per share? And now when we look at the risks and possible challenges, I mainly believe that they are experiencing a worsening competitive landscape with more and more competitors offering more innovative solutions, flooding the market, and just overall forcing all of these companies to lower their pricing and obtain even slimmer margins than the ones that they currently have. And this is why over the past quarters, they have not been able to actually increase these margins at a fair pace. And the second one being the cyclicality risk. Because since these companies actually earn their revenues from a fee placed on their clients, they're very dependent on the revenues and the earnings that their clients actually generate. And in times of an economic recession, expenditure on any type of business tends to go down, which would inherently reduce the amount of fees that Shift4 Payments would obtain, hence decreasing their revenues and making them follow a cyclical nature. So now before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a strong competitive advantage. It provides consistent cash flows, but it does not have a high return on capital employed, meaning that it is currently not creating value for the investor. So although I believe this is a good company and it has good potential, I believe that their current slim margins and how competitive this sector is, I will not be starting a position on this company as the risk to reward ratio for me is just not there. Now having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content and I'll see you in the next one.